Hey, everybody, welcome back to Chipstock Investor. Hope you're having a great day so far, a great week. We're here to talk about Qualcomm. The reason we're focusing on Qualcomm in today's video is because Qualcomm has been a top pick for us here at Chipstock Investor the last couple of years. You probably know how it did this year. And if you haven't seen our video yet, we did a review of our top picks for 2024. Qualcomm didn't end up on top.
2 years in a row, kind of a middling performer, and that's okay. It's kind of a core position for us, but we never expected it to be the highest growth business, but still solid overall returns when you include the dividends. But the reason why we need to talk about Qualcomm is we never got around to doing a video on the Investor Day in November 2024. And this Investor Day really amounted to a product diversification update. As many people know, and as many investors have been talking about for years now, Qualcomm and Apple don't get along. Qualcomm is a top supplier for Apple's products, supplying 5G modems. They did renew the supply agreement at the end of 2023, and that supply agreement lasts through at least 2026. A lot of rumors about how Apple is going to wind down its reliance on Qualcomm. Nevertheless, Qualcomm actually has been telling investors all along for several years now to just assume that by 2027, no more revenue or profit from the Apple relationship. So, what are they going to do about it to replace this pretty sizable business? Could be about one quarter of their actual smartphone segment. Enter November 2024 Investor Day.
We can call it the Diversification Day.
Yeah,
Let's call it Diversification Day.
and this slide explains why we could call it that. Qualcomm has indeed actually successfully expanded far beyond just its core smartphone business. Let's unpack some of the material that they revealed to us about their long-term plans. I'm sorry, I said unpack. I'm using one of the cliche analyst terms that Casey hates. Let's unpack it.
We'll provide more color.
And we're going to double click on this.
In several of our Qualcomm videos, we have pointed out their increasing market share in the automotive segment. They have really grown throughout this past year in spite of a very severe auto and industrial downturn in the overall market. It really looks like Qualcomm's auto sales are going to surpass 4 billion next year, which will be fiscal year 2025. In fact, not just automotive, but every end market for Qualcomm grew sequentially in the last quarter. You can see automotive came in at 899 million for that last quarter of fiscal 2024. Qualcomm is landing all sorts of deals for vehicle connectivity, advanced driver assist systems, and infotainment systems.
Yeah, interesting little tidbit here. One of the reasons Qualcomm has been successful is because the broad product lineup that they have for automotive. This differs a bit from NVIDIA, which is focused on advanced driver assist systems for automakers that are working on self-driving car technology. Qualcomm also in on that as well, but NVIDIA actually exited the infotainment business a number of years ago. And so Qualcomm's been kind of mopping up a lot of the leftovers here in this market. That could be one of the reasons they have greatly outperformed their automotive chip supplier peers. Now, Casey, one of the worries, though, with Qualcomm diversifying outside of smartphones that's been brought up a number of times by analysts and investors is gross margins on these new products not being as high as the smartphone business. That kind of goes without saying, though, right?
Yes, whenever there are new products introduced, there's definitely going to be a risk for profit margins taking a hit, especially in the beginning. And CFO Akash Palkawala mentioned this specifically in his comments at this investor day. He pointed out that specifically in PC, they're just starting in the market. And so that's a place where they do have significantly lower gross margins than the Qualcomm average. He's talking about the Snapdragon X Elite chip, which is going into new PCs. This product is just hitting the shelves. Of course, there's going to be lower profit margins, especially in the beginning. So, Nick, what exactly is the basis for these questions about lowering gross profit margins?
Yeah, maybe a chart like this one. This shows Qualcomm's revenue and gross margin percentage. You can see while revenue has increased the last 5 years since the fiscal year that ended in September 2019, gross profit margin has declined significantly. So it's already happened, actually, as Qualcomm has begun its diversification strategy into new products. The gross margin has already taken a hit. So the worry in our mind is kind of actually already in the rearview mirror. We're already beginning to lap the effects of that. Also, what is more, gross margin doesn't pay the bills if you're a shareholder. Free cash flow pays the bills. And we've covered this already numerous times in the last couple of years. Qualcomm is putting up a very, very healthy free cash flow profitability even in the midst of them expanding into new products, multiple headwinds for the business and the semiconductor industry overall. First, the pandemic, and then the Fed's interest rate hiking cycle. And so, the gross margin conversation, really, it shouldn't even be a conversation. It's just a given when a new product is launched, even if it's a third party that's handling some of the manufacturing, in this case, Taiwan Semi Manufacturing, of course, gross margins are going to take a dip. But what is the free cash flow actually doing? And so, if you're going to calculate free cash flow, you need to start with operating income first. And so, as you can see from this first chart here from our friends over at finchat.io, you see the gross margin headwind. Already, it's been an issue for the last few years, but along the way, the QCT segment, basically products, read products when you see QCT mentioned, the margins before taxes have at the very least been stable.
Yeah, you're looking at the same chart, but with QCT operating margins highlighted every cycle peak for the last decade. Is this a really scary chart? Not really, if you're okay with making money.
Qualcomm is going to be just fine as they diversify their product lineup.
Before we continue, quick shout out to FinChat, who is the sponsor of today's video and who helped us make those two charts that you saw, and a couple more coming up in this episode. You can get 15% off any paid plan with our link in the description, finchat.io/CSI. Nick, why do you love FinChat?
It's really a great full software suite if you're interested in analyzing, of course, not just stocks, but more importantly, businesses. Lots of metrics, including things like KPIs or key performance indicators. For example, if you're trying to figure out how Qualcomm's CDMA technology or QCT segment is doing, those expanding product lineups, FinChat has that at your fingertips where you can, with a very quick couple of clicks, get the QCT revenue and operating income for the business all in one chart.
FinChat is something we use every single day here at Chipstock Investor. If you're interested in analyzing a business like we do, check out our link in the description below. finchat.io/CSI gets you 15% off any paid plan. Overall, Qualcomm's operating margins have bounced around a bit the last 5 years. And that's really natural given the effect of the pandemic, the Fed interest rate hikes, and the bear market that ensued because of that. But free cash flow has continued to rise.
Yeah, and that's especially the case on a per share basis. Free cash flow per share is the line there in orange. So over the last decade, and especially the last 5 years, you can see that metric has continued to rise. That is a sign of a healthy business. And if it's GAAP net income per share or earnings per share that you use, that's actually been pretty good as well. That is the blue line. So yeah, gross margins and operating income margin is the purple line. It's been bouncing around, but overall, the business's per share profitability has been actually quite good.
Okay, we've been spending these few minutes talking about everything except what everybody keeps fixating on, Apple. Let's talk about that one more time. Let's bring that up again. Let's assume that Apple does continue down the path of ending their relationship with Qualcomm and terminates completely the revenue that was generated from that in 2027.
Okay, that's a safe assumption. It's what Qualcomm management has been telling us to do, and it's what we've been factoring for all along. But management would like you to know that their new diversified revenue streams far exceed Apple 5G modem sales. And so overall, this should still be a profitable growth story for Qualcomm shareholders. And in fact, by 2030, the expectation is that automotive and IoT alone will have far and away exceeded parity with the remaining smartphone business ex Apple. So again, this chart, especially on the bottom right quadrant of these slides, top left quadrant is the growth of IoT and automotive through the end of fiscal year 2029. Bottom right quadrant is the 2030 target for their products. We're looking at a business that is at least 50-50 between smartphones and auto and IoT, if not more auto and IoT than smartphones.
You can also top that off with the fact that smartphone sales are still expected to keep growing at an average mid-single digit percentage rate through the next 5 to 6 years. It's not like everybody's going to continue to not buy cell phones.
Yeah, and on that note, we do have all of our research notes available over on Semiconductor Insider, including the notes that we did in January of 2024 on 5G and Qualcomm, and how average selling prices per chip, ASPs per chip, are actually on the rise for Qualcomm thanks to the 5G transition for smartphones. So even excluding Apple, we think Qualcomm is actually going to be just fine in that smartphone segment.
So that leads us to the question, is Qualcomm stock a buy? You do need to factor for Apple sales going away sooner or later. And It seems that's exactly what the market has been doing. On a 1 year forward basis, the market has not allowed the stock price to go any higher than a 20x multiple. You can see that even earlier this year, that was just about at the peak. Now, Qualcomm stock on a forward basis is sitting around both on a price to earnings basis and on a price to free cash flow right around 14x.
Yeah, again, check the last video that Casey linked at the beginning of this discussion on our 2024 chip stock review and where our portfolio is at for 2025 for a few more details on this. Part of it is just a delay in the recovery for the semiconductor industry overall. However, we are still early on in maybe a new chapter for consumer electronics, as well as just the continuous management of the down cycle in auto and industrial. And Qualcomm looks like it's going to do quite well in that segment as it begins to recover. They've done well throughout the downturn, so why wouldn't they do well in the recovery? So overall, we think the stock looks like quite the value again after this latest downturn in share price.
So, who might be interested in having Qualcomm in their portfolio? We have this broken into three different types of investors. The first one might be the opportunistic buyer looking for a well established but cheap business. Qualcomm's end markets are at the beginning of an upcycle, so it definitely provides some high probability in growth going forward.
Second, because Qualcomm yields exposure to a lot of different end markets in the semiconductor industry, including automotive and robotics, which we didn't talk much about from that Investor Day update today. So, for investors that need core portfolio position in the semiconductor industry, Qualcomm could be one of the companies that checks that box as well.
And finally, the investor who likes dividends. Qualcomm has continued to provide share repurchases and a growing dividend. So, especially if you hold this stock for the long term, it may make sense.
But I think we probably should emphasize one more time, do mind the risks with the Apple business going away. That is going to be some sort of headwind over the next couple of years. And as Casey mentioned, we have a hard time seeing the market rewarding Qualcomm stock with anything more than a 1 year forward 20x multiple on either gap price to earnings or price to free cash flow basis. It probably doesn't matter much. So where are we at with the stock? By now, you probably have gotten the idea that this is a core position for us in our semiconductor industry basket of stocks. So we have no room to add to it right now. But if we were, I guess I would categorize us as maybe category number one, an opportunistic buyer looking for a cheap stock right now. That seems to be where Qualcomm fits. So I don't think we're going to call this a top pick for us in 2025 like we have the last 2 years. Let's call it an opportunistic pick at the moment. And of course, we'll continue to cover this one as 2025 progresses. A lot of good stuff happening over at Qualcomm.
Make sure you hit the subscribe button, like the video, and share with your friends. We appreciate it greatly here at Chipstock Investor. And check out Semiconductor Insider membership, link in the video description below. You can get that on our Ko-fi page. Everybody take care. See you again soon at Chipstock Investor.